And Doug, I didn't get a chance to ask you, how's the sound through my
Good.
headset and everything? Everything sounds fine?
Yeah, you sound great.
Sorry, I meant to ask that earlier.
Okay, we're going to go ahead and get started. Good afternoon. My name is Doug DiVirgilio. I'm a mentor at Minnesota SCORE and also on the Minnesota SCORE Education Committee. And welcome to our webinar, Borrow Smart, Choosing the Right Loan for Your Business Needs. And Frank Maggio is going to be presenting to us. And before we get to Frank, just a few comments about SCORE. So what is SCORE? For those of you who don't know, it's a nationwide organization affiliated as an independent resource partner of the SBA. And we provide a free, there's the big word, confidential business mentoring, online courses, all kinds of templates, and most importantly, our mentors. There's 300 chapters nationally, 10,000 mentors nationally, and in Minnesota, so Sarasota, Manatee counties, 90. And they're from every possible business background, mostly retired executives. So we can help you in many different ways and match up expertise to your needs. Our chapter has recently been recognized as District Chapter of the Year. And since its founding, it's back to 1964, SCORE has assisted over 11 million small businesses throughout the U.S. So how can we help? Well, there's many ways. These are just a few. Many people are dreaming about their startup business, what they want to do, and been thinking about it. It's hard to do that. Again, we're here as mentors to get you resources, be sounding boards, help you plan for that, because there is a lot of work to do with that in research and planning. Startup phase, same thing, getting going. How do you get qualified for the loans that Frank can provide? And what do you need financially to do that? In business, growth has been an obstacle for a lot of people. Really positive growth actually can be a hindrance. So you've got to know how to manage that well. There's a lot to do with that. And buying, selling, or closing your business. We can also help with that. So just a few ways that Mentor at SCORE can help. You can visit score.org/Minnesota. You can look at mentor profiles. You can request a mentor, which I highly recommend. You can see the workshop calendar, also get recorded webinars. In fact, each of you will receive the recorded webinar and Frank's slides after our presentation is concluded. We need to thank our partners, without which we wouldn't be able to provide all the services we do. One of them is BayFirst. Frank is with BayFirst, so thank you, Frank, for your support of SCORE. Now, let me turn it over to Frank. Frank, maybe you can introduce yourself a little bit. I don't have that bio in front of me right now. It's supposed to be on here. So
That's okay.
let me stop screen sharing, and Frank will go to his slides, and we'll go from there.
And let me go to there and share. You can see it, Doug?
Whoop, just a minute. Yep.
Perfect.
Yes.
So the quick and dirty about me, my name is Frank Maggio. I'm a Vice President, Commercial Loan Officer here at BayFirst Financial, which is a community bank. We are technically a national bank because we are publicly traded on the NASDAQ under BayFirst Financial, but we are a community bank because we're located in downtown St. Petersburg and have offices in Pinellas, Hillsborough, Manatee, and Sarasota County. Full service financial institutions, so we do offer everything from depository lending, full lending from consumer, residential, commercial, including conventional and SBA loans, and also have investment advisor services as well. But we are a community bank. Our physical footprint is in the Tampa Bay market, essentially. But because we are an SBA lender and a PLP lender, which I can answer questions about that, what that means and what the benefit of that is. But because of that platform, we can lend nationwide, especially for small businesses and startup businesses. I've been in banking since 2001. How I'll never forget when I started is that my first day in banking in my banking career was the Thursday before that Tuesday in September of 2001. I think everybody that probably knows the day I'm talking about. Most of my career has been spent on the commercial lending side, half of it on the underwriting side, or about half of it on the underwriting side. So basically, the people that support what I do now as a commercial loan officer, talking with customers and helping them out with a loan, selling them a loan, servicing their needs, things like that. I handled the side that actually underwrote all of those loans and did those things. And then the rest of my career more recently has been spent more on the commercial actual production, what we call production or sales side, as a loan officer, talking with business owners, talking with individuals, developers, investors, things like that. Primarily, most of what I do is on the what we call conventional commercial side. So I do not specifically handle SBA loans, but I can talk SBA, so I can answer any questions about those or other loans, including residential, consumer, and all of those. And again, I've underwritten pretty much all of those loans throughout my career. Um, the bank itself, like I mentioned, is located locally. We are a national lender and we are publicly traded. That comes with different regulatory requirements and agencies that oversee us. But that's the quick and dirty on me. Born and raised in Florida. I graduated from Florida State University in the mid 90s, and then moved down here to the Sarasota area. And I've been living here since 2001 in the banking industry for that amount of time. That's all on me. I just want to focus on kind of the slides itself. And as I mentioned to Doug earlier, for those of you that might have not joined when we were just kind of chatting back and forth, if you have questions, drop them in the chat. If it's something, what I'm talking about, Doug will interrupt me and I can address it. Otherwise, we can focus on more Q&A kind of towards the end of the slides, but we'll jump right in. So borrow smart, choosing the right loan for your business needs. Kind of a short way of saying sometimes there's more than one path to get to what you need. But overall, let's just talk about lending. Consumer loans are probably the thing that most people gravitate or think about when you say loans and lending. And in most particular, people probably think about a home loan, and that's a type of consumer loan. In the banking industry, we usually call that a residential loan, but it's still a consumer loan because it's a loan to an individual as opposed to a loan to a business, commercial or business loan. But consumer loans typically are home loans, home equity loans, home equity lines of credit. So home equity loans could be things for like, replacing a roof and then that's going to fully amortize, or a line of credit might be for just a kind of an open use. It's basically a credit card secured with your home. Auto loans, student loans, even personal loans that are unsecured to consolidate debt, things like that. Those are all consumer loans. Vehicle loans I mentioned, personal loans, home equity loans are a lot of times the ones that most people usually are utilizing, and especially right now with interest rates being somewhat high but pretty manageable, but also value of real estate having gone up relatively recently in the last, say, 5 to 10 years. People are utilizing that equity in their home to help them improve their home or potentially for other needs. And I'll address some of that because there are some creative ways that businesses can use even the equity in their homes to help with their small business, either starting it up or expanding it. And other type of loans, education loans. We as a bank, BayFirst, do not really handle education loans. By and large, you'll find most education loans are done through national companies, directly through the education services, the universities themselves, and then you work with companies like Navinet or Nelnet, I think, or I forget the names of them, but those are more education loans. Usually those are handled by government agents, or excuse me, agencies that work directly with the government on education loans. But mortgages for most banks, those are usually kind of the bread and butter consumer loans, doing 30-year fixed rate or adjustable rate mortgages for primary residences or second homes or potentially even investment homes. I want to explain just a little bit about lines of credit and installment loans, and really the differences in those two. And this particularly kind of comes up, especially when you look at home equity loans, but also does translate over to commercial and business loans. So the flexibility you have on a line of credit can be different than an installment loan. Installment loans typically are a specific need. A bank will finance that specific need, and whatever that need is where the money goes towards, and then that's amortized out over a specified period of time. Depends on the type of loan or the need for the loan. That usually dictates rate, term, structure, things like that. But by and large, the biggest difference in a line of credit and installment loan, obviously, is you've got a credit card. You can use that however you want to. You can pay it up. You can draw it up. You can pay it down. It does require payments that are a minimum amount, but there's flexibility there. Whereas an installment loan, it's a term loan, like your mortgage, for example, P&I payments. It's an identified amortization to fully pay the loan within a specific period of time, 5, 10 years, 3 years, whatever it is. So there's there's flexibility there. However, with a line of credit, typically there will also be variable interest. Typical feature for a line of credit is that it will be tied to a identified interest rate, like prime, for example, which is a lot of people will say prime, or what that means is Wall Street Journal Prime, which is a specific outlet that provides that service or provides that index. But ultimately, prime is what is dictated by the Federal Reserve. The Federal Reserve dictates what's called Fed funds rate, which is the rate that banks and financial institutions borrow against the Fed or against the Federal Reserve. And prime is dictated by that rate plus a spread. Typically, it's the Fed funds rate plus a spread of 3%. So right now, Fed funds is at 5.5%, which means prime is at 8.5%. And in most cases, most lines of credit, particularly consumer lines of credit like home equity lines or particularly business loans, even a lot of SBA loans that are floating rate are tied to that prime rate, and it depends on the type of loan and the structure and the situations that dictates a spread over that prime rate. Lines of credit typically will have annual fees, whereas is on an installment loan, typically you pay for the fees up front and then you never see fees again unless you have things like late fees and you don't pay on time, things like that. And then lines of credit, they can be collateralized, they may not be collateralized. More often than not, most traditional banks will collateralize them, but yes, there are situations where you could not have collateral. For example, like a credit card, most of those are done with no collateral. And again, the payment, lines of credit typically are interest only. You pay the principal when you can. Term loans are P&I, usually principal and interest payments, so that it can fully pay back the loan over time. So businesses, because that's really more of the direct focus of this conversation today. Why do businesses borrow money? Really, at the end of the day, businesses borrow money because obviously they need cash, but there's usually an identified need. So, you might be a business that's starting up and you need startup capital. That's what we call working capital or capital. It all means cash. All of those words mean the same thing, cash. Or you have a specific identified need, meaning equipment. Again, you need cash, but it's for a specific use. Or you're purchasing something other than equipment, like real estate, or you're hiring people. Infrastructure. That's technically still working capital, but it's working capital for a specific need, a tangible thing, a person. You want to hire people, employees, things like that. There's also situations you see on the slide where there's owner buyouts. You might have a situation to where, maybe you want to start up a business, but there's an existing business that you're actually buying. So you're buying out somebody, or you're already a business owner and you're buying out a partner. They're no longer involved in the business, or you just want to, you're 50-50 owners and they've moved on and you'd like to buy them out of their ownership. Or in a lot of cases, it's somebody owns a company and it's what you'd like to do, or if it's something that you have expertise in, and rather than reinventing the wheel, you're going to buy their business and buy their receivables and their assets and their customers essentially, and take that existing business and make it your own. But those are all typical loan uses. So by and large, you're looking for things like, for most businesses, it's basically cash you're looking for, and you're usually using it for a term or installment purposes. So it's a traditional term loan. So back to that prior slide, talking about the differences in lines of credit or installment loans. Most of it's usually on an installment basis, but businesses can use lines of credit, particularly related to working capital, especially businesses that have seasonal needs. So companies that have, higher times with customers asking for, customers and vendors asking for work, but yet you're not collecting as much of the money right now. But then when the low times happen, you might need the assistance of some additional cash to pay your employees, or, purchase some additional inventory, or, something to create your whatever it is that you're doing, whatever your business produces or service it provides. And you might need that seasonal, that's where the seasonal need comes in, and why a business might have a necessity for a line of credit. So when it has that low time, it needs to draw on a line of credit, kind of like a credit card. And then as the money comes in from the work that business is doing, that cash flow, that money coming in, is what repays that line back. But those are typical uses for business loans. Excuse me. BayFirst Business Lending. Pretty much everything I just mentioned, we handle. In fact, everything I did mention, we handle. And these are just some typical loans that we handle: commercial real estate loans, commercial term loans, which can be things like equipment loans, lines of credit, as I just mentioned, construction loans, actually ground up building something. So a commercial real estate loan will do. So a business is looking to buy a location that maybe it was previously renting and it wants to buy from the owner of that property, or it just wants to move out from that property and buy its own real estate because it's expanding. Maybe it needs more square footage to operate under, a different type of property, whatever the case is. But it's no different than an individual saying, I don't want to rent anymore and I don't want to pay somebody else's mortgage. I want to own my own home or own my own condo unit or whatever the situation is. It's no different than a business. The business could build equity and have a tangible piece of asset that it can call its own. But we can also handle construction, so ground up construction loans. And heavy equipment financing, that kind of falls under term loans, but we do also specialize in heavy equipment financing. So this would be for construction companies or specialized equipment that's larger and or has a longer lifespan. Certain companies that I've worked with, like construction companies, even companies that are involved in contracting, have purchased things like cranes or equipment that physically lives on the property that they operate on. I mean, it's not movable, so not like a crane or a big truck, but even equipment that physically stays on site that is integral to the operations of that company and how that company makes cash flow. That would be kind of heavy equipment financing, but it's all term loans. And in particular, I mentioned SBA lending. SBA, for those of you that might not be aware, is Small Business Administration. So this is government lending. So back in I think it was out of the 40s, so it was out of the Second World War, and the government legislation passed the government passed legislation, is what I mean to say, to allow for Small Business Administration lending. As troops were coming home from the war, they needed a place to call home and actually work. And in a lot of cases, they wanted to start up their own businesses, and there was not really a resource for that. So the government created the SBA, and out of that was the original use, but out of that became the necessity for the government to focus on creating jobs in America. And that, by and large, is primarily the purpose for the SBA. If you have a new business you want to start up, you have a business you want to expand, you have an existing business and you want to franchise it and go to different locations, or there is a franchise and you want to, as a business owner, open up a franchise of whatever public name you can think of. That's what the SBA is pretty much there for. By and large, if you're a startup, franchise, expansion of the business, all of those terms, as a commercial lender and as a bank employee, those are the key words that I hear and will listen to and think, okay, this might be more of an SBA loan. And that's where I would communicate with one of my partners that is in our SBA department here at the bank and have them work with that customer. But SBA loans are typically low capital infusion, meaning low cash for the business owner to inject. So you're looking to start a business, expand a business, what have you, and you need X amount of money, and you don't necessarily have cash to put in, which is typically what happens, say, for example, when you buy a home, you have to usually put about 15, 20% equity or cash into that purchase, that home. Businesses work very similar to where the banks finance businesses. They typically require cash in. Well, SBA does not. Typically, they require either no or very little cash in. Usually, in most cases, it's about 5%, somewhere between 0 to 5%. It doesn't mean you couldn't put more cash in, but typically it just means that as a business owner, you're not required to put as much as cash in. But when those things happen, there are usually things the SBA also requires, or there's additional collateral in those situations. But SBA loans are good options for business owners, just because it's quicker and easier access to cash. It also does mean that there are differences in those types of loans as opposed to traditional, conventional commercial loans, which I'll explain. Some of this is vernacular, so what I'm about to say is different with different banks. What we call a core loan, in most cases, really what that means, it's an SBA 7A loan. SBA loans typically fall into two categories: what's called a 7A loan or what's called a 504 loan. 504 loans are specifically used for construction, almost 100%. There are a few other uses, but primarily that's what they're used for. So SBA can also finance construction, but it would be construction for an operating business, not for things like investment property or things like that, but for operating businesses, and can include things like hotel, motel, self-storage facilities, car washes, things like that. But they have to be operating entities. They cannot be for investment, meaning for rental of property. It has to be for operating entities. But what we call core loans, those are essentially 7A loans. Those primarily are used for purchase of real estate, starting up a company, buying out an owner, buying an owner, so buying a company and buying their operations, things like that typically are what fall into what we at the bank call core loans, or essentially are what we call, or what the SBA deems as 7A loans. That is the loan program, the 7A. 504 is the loan program for construction. What we call bolt loans, these are quick and easy access. They're 7A loans as well, but these are quick and easy access for up to $150,000 and in a minimum of $25,000. So small business has been in operation for a couple years and wants to hire a few people, needs to inject a little bit of cash into the company to help it keep operating, and it only needs $100,000. Perfect example of what we call a bolt loan. It is still technically a 7A loan, but it is a quicker process. It's more of an automated process, and a lot of banks have loans like this. We call them bolt loans. Some other banks call them different things, but these are basically quick and easy. Usually it's an application, maybe a few financials, some signatures, and usually within 48, maybe 3 or 4 or 5 days at most, and you can usually get a response back, yes or no. And then usually within a week, maybe a couple days or a week after that, you're closing a loan. So potentially within a week to 2 weeks or so, you can get a quick and easy access to capital. It can also include things like purchasing equipment. So it's a little more easy access to basically working capital cash. And there's 504 loans. I mentioned that these are construction primarily. They can be used for things like equipment and things, but primarily they're used for construction, but they can be used for equipment, especially larger operations. I'd say more in the million to multi-million operations, to where a company like that would need to buy 100,000, 200,000, 300,000 size, pieces of equipment. Those can be best handled under this SBA 504 program. But by and large, they're pretty much the same loan product. They just have a slightly different use and slightly different conditions in them, essentially. USDA loans are specialized SBA loans. These are primarily used for startup businesses and primarily used in kind of what we call opportunity zones, or in this case, it mentions agriculture because it is backed by the U.S. Department of Agriculture. Essentially, if you're a business and you're looking to start up in an area that's deemed like an opportunity zone, which is kind of a word that's been now used over the last 5 years or so, these are typically rural areas where a community or a county or a state, in that for whatever example, is trying to focus on developing business and also developing a community within a certain area. It is an underserved area, not necessarily CRA, but meaning that it is an area of development or growth. And those loans can be handled by USDA. So the same example of a 7A loan to where you're looking to start up a business, well, you actually might be able to, instead of use the 7A product, you might be able to use the USDA product because that area that you're looking to start that business and operate that business out of might be deemed a rural area that is a expansion area deemed by the U.S. government and the SBA as an expansion area that qualifies it for a USDA loan. It's the same type of loan. It's just you get a little bit more bells and whistles and a little bit more focus on those areas because it is a development area. And there is a list of that. It's actually available directly through the USDA, which is under the SBA's website. And all you have to do is basically just go to that website, look up USDA map, and all you have to do is plug in your address of where you want to operate your business or where your business is going to be located, and it'll tell you very quickly if it would be eligible for a USDA loan. And that's what the bank utilizes. Actually, that's how we search if a potential loan could be eligible for USDA. What's the difference in conventional and SBA loans? So I've touched on a little bit of this, but I want to talk a little bit more because this can sometimes for business owners be a little confusing. By and large, they're loans. So they're the same product in the sense of, it's a promissory note, there's security. So there's some kind of a mortgage or lien placed. There could be guaranteed. In most cases, there's always guarantees, meaning the business owners, are guaranteeing that product. So, it's not just that the loan is to the business, but also those individual owners are guaranteeing that if something happens, they'll step in and make it whole. There's other documents that go into it. By and large, it's pretty much the same thing. There's a note, an agreement to pay. This is how you repay the loan. This is what it's secured by, and here are potential ways that it can go right and wrong, and any kind of requirements going forward. Where they differ is more of the detail. So for conventional loans, as a conventional lender, I can do a real estate mortgage to an operating business. Well, so can the SBA. The structure of that loan can be very similar. The mechanism, the documents will be very similar, but how you go about it and how they're the pricing and the details of it can be a little bit vastly different. So on a conventional loan, it's not backed by the government, whereas on an SBA loan, it is. And where that's important helps both the bank and also the customer or the business. An SBA loan has a government, backing, and SBA backing, and in most cases, usually it's about 75 to 85% of that loan. So in the case of, say, $1 million mortgage that I could do conventionally, as opposed to an SBA $1 million mortgage, well, more than likely the purchase of that property as a conventional loan, it was probably closer to $1.5 million, let's say, because I'm going to require you on the conventional side to put at least, say, 20% equity in. So maybe a $1.2 million, $1.3 million loan, you got to put about 200,000 or so into it. So I'm going to do $1 million mortgage. On the SBA side, the purchase price actually might be $1 million for that property, and we're also going to finance $1 million. And the reason why is because you're going to put maybe 5% equity in, but also the SBA can finance things like closing costs, or maybe you need to also hire a few people. They can put working capital into that request as well too. Whereas on my side, on the conventional side, I'm only going to do just the purchase of that real estate. Well, the SBA can throw a few extra things in there, plus also they can finance more of it. So there is that, but there's a backing from the government. And that backing means that if something happens to that loan, the government will step in and help the bank make whole. It also helps you as the customer because it means that there's less burden potentially on you if the bad thing happens and if it goes the bad way. Creditworthiness typically is going to be the case on both sides. So typically you're going to have that both SBA, but also on conventional, where the SBA is not as does not require as much creditworthiness is because it could be a startup company. So in most cases for a conventional loan, we're going to look at your historical cash flow, make sure that that company has been in operations for typically a minimum of 2 to 3 or 4 years. And that means that you've been in operations at least for 2 to 3 full years to where the cash flow of that company is going to show historically that you can repay back that loan that we're going to do. Well, on the SBA side, because it's primarily used for startup businesses and expansion and things like that, there's a lot of projection that are used. So in most cases, you're asking for a loan that you might be able to get conventionally, but if you're going to get it SBA, it probably means that there's no historical background, there's no historical cash flow. You have a good idea, you have a business plan, you have expertise, you have people around you that have built a good business plan of here's what we think we can do with the business, here's how much money we think we can generate, maybe a best case and a worst case scenario. The SBA and the bank is going to utilize that and say, okay, this sounds like a good risk for us to take. But so the creditworthiness is a little bit less than what it would be on a conventional loan because we're actually utilizing on a conventional basis more historical actual numbers. This is how the company is actually operated, as opposed to this is how the company might operate as a projection. That's a big difference between a conventional loan and an SBA loan. The other things, specific terms, criteria, there's a lot of things that can encompass. Interest rates are typically lower on a conventional loan, almost always, as opposed to an SBA loan. I mentioned earlier, SBA primarily uses prime rate. Prime right now is 8.5%. In my scenario of a real estate mortgage, that loan might be about 8.5 to 9.5% on a traditional SBA 7A loan to purchase that real estate. Well, on the conventional side, right now we might be looking at 7% or so. So it can be as much as 2-3% difference between a conventional loan and an SBA loan. And that's very typical. But part of the reason why and the justification for that is that you're putting more cash into a conventional deal typically. So the risk is a little bit lower for the bank and also for you as the business owner, as opposed to an SBA loan, which typically you're not putting as much cash in. There's more risk in that situation. The bank is footing, and in that case, the government is putting more money into that project than you as the business owner are putting into that. So that's how partly how risk is managed is by charging a little bit more of a premium for that risk. Plus also there's some other differences too, and to mitigate some of that risk on the SBA, because there might not be collateral, or there may be in the situation of that mortgage, there is collateral if you're buying a piece of property for that business to operate. But because you're not putting as much money in, the bank is footing more of that bill, and there's a higher risk there. And some of the mitigation to that risk, some of the way for the SBA and for the bank to get over the hump, justify that risk, is by taking other collateral. And in most cases, SBA will typically look at the individual owner. And if the individual owner or owners have equity in their home, they will typically take a second mortgage or some kind of junior lien against, say, your home. And that's a way to shore up some of that risk, to mitigate some of that risk. So if that loan were to default, as a business owner, you understand that you're not only at risk for that property, but also at risk potentially for your home. That is a very different thing that happens on the conventional side. Typically, conventional matches purpose, use of proceeds with the collateral. You're buying a commercial property, and how you're repaying it is the cash flow of the business, but the collateral it would be that business location, that piece of property that we're using the funds to purchase. Business options, variety of needs, yes. Involve credit check. Yeah, all those middle things pretty much are for both SBA and conventional loans. I'll stop right there because that's a lot of information. What questions do people have?
So if you have questions, please go ahead and type them into Q&A or chat. A lot of great information, Frank. I get asked these questions all the time when I'm talking with my mentees. So questions on, I know it can be confusing, but Frank laid it out pretty clear. Anybody, any questions?
And a lot of information too.
Tons of information.
Yeah, unfortunately it's like drinking from a fire hose. SBA can be very confusing for some customers and for some businesses just because there are a few more bells and whistles to jump through. There's specified for specific, very standard forms you have to use, things like that. So somebody asked a question. Looks like Dennis has raised his hand, but somebody else.
Can you go ahead and type it in, Dennis? If you put it in the chat, there we go.
Oh, he said, sorry, it was a mistake. Maybe he didn't mean to ask a question.
All right.
Gotcha.
Any questions on any topic? Nothing is too silly.
Yeah.
Don't think that.
I tell my customers all the time, just ask the question. I'd rather address a question, even if it seems, even if it makes you think like you're going to look like you're stupid or something. I'd rather you address a question now rather than dealing with it later on.
All right. So does SBA provide support on choosing the right loan?
Yes. Yeah. I mean, by and large, so the SBA, when we say the SBA, let's back up a second, because this can be confusing for some customers as well. In fact, it's confusing for some bank employees. Whenever anybody says SBA, typically they're referring to the actual government itself. That is the SBA, the Small Business Administration. But at a bank, when, like I say, my SBA department, that just means that's a specialized department that works with the government SBA. So to answer your question, the government SBA has some resources, but by and large, you're going to find, just like this wouldn't be a surprise to anybody, you're not going to get somebody on the phone or get to talk to somebody directly, even go to an office and talk to somebody. Typically, you're going to talk with people like Doug and myself, people that have experience or understand these SBA loans and how you can best be driven to what product would work best for you, and to understand these products better. Those are your resources. So be going to somebody like Doug and SCORE. They're going to understand SBA loans and what they are. And you can also go to the bank, and people like myself or people that I work with that work in my SBA department at this bank, and they will help you in that process. So you might be ready to do an SBA loan, but you don't necessarily know exactly what you want to do. And that loan officer or those production individuals, they can help you best navigate that. By and large, though, SBA loans are pretty cut and dry. There's just two types, a 7A and a 504. But it's also understanding maybe and most people are going to want and are going to utilize the 7A. That's the flagship product of SBA. But in that product, though, you're going to have questions about, what can I utilize? Back up to what I said before about like that example of a purchase of a real estate. There are a lot of things in an SBA 7A loan to use to purchase for that real estate that the businesses can throw in on that you don't can't do, and you won't be able to have options on with a conventional loan. But on an SBA loan, let's say you're a business and you've occupied a property that's 5,000 square feet, and you see a property that's 6,000 square feet, and that's a great opportunity for you because you can move from leasing to owning. Plus, the larger square footage is going to give you an opportunity to expand. But with that, you need to buy some things, some equipment, maybe some furniture. You also might want to hire some people. Those are things that your SBA lender can coach you on, and say, okay, we can help finance some of that possibly. Yeah, the real estate is $1 million, but you've also got another $250,000 that is going to help you, get some cash, get you into that property, because there's going to be a ramp up period. You might want to hire a few people, whatever. Those things could be thrown in as well too. So yeah, definitely there are people within the bank and things like score coaches that can help you best understand, how you might be able to piece together an SBA loan and what you can finance and what options you have. It's a great question.
So Frank covered that well. I just want to add that what we're here to do, really, because he's busy, and most bankers are, is to try to help make sure your package, your presentation, your credit history is going to be something that he can work with. So we can help you get your package ready, prepare your financials, prepare your business plan, things that he's going to need to see to help him make a loan decision, or the SBA department there. Again, the SBA typically guarantees bank loans. It's not something you go to directly. There's a lot of places that are partners of the SBA, but we can work with you to help you qualify, and we would refer you to people like Frank, who are very, very good at working with small business and want to work with small business. Anonymous attendee, are there any annual grants available as well, either for veterans or regular small business?
Yeah, so I mean, really, the answer is no. There's not grants specifically, although there are grants out there, but they're not through the SBA. They're through the Veterans Administration or VA. There are, I know, some grant opportunities for things like that, but those aren't specifically SBA. The SBA, however, does take into, I can tell you, they do take into account things like women-owned businesses, veteran status, things like that. Those are taken into account, but it doesn't mean that you're eligible through the SBA for like certain grant products. But there are grant products that do exist for things like, say, veteran, but that's typically through the Veterans Administration or the VA, essentially. So hopefully that answers that question.
Yeah, we can work with you on grants as well. I will tell you, grants are harder to obtain than sometimes an investment capital, certainly harder to obtain than a loan. You got to work really hard at it. They're out there, specifically for minorities, but they're available, but they are hard to get. Dominic Lewis, for SBA, do you have to have collateral to qualify, i.e., a home?
No, so I just mentioned about collateral, about mitigating collateral as taking like a second mortgage or a junior lien on a home. It is not a requirement, no, and it isn't something that discounts or excludes you from being able to get an SBA loan. It just may mean that if there is a higher risk or it is a larger loan, there may be more of a situation to where that loan might be declined if it's, say, too much money and there isn't any collateral at all, and it's too much of a risk, and the SBA may just kick it out. It's not even a bank situation. The SBA itself may kick it out for certain reasons, but unfortunately, questions like that, I can talk general enough to say, no, you do not have to have a home. I mean, that's a general answer to that question. However, I can say that based on situation by situation basis, if we're talking about a $50,000 cash loan, not cash secured, cash loan that's needed for a cash injection for a business or maybe a startup business, and you only need $50,000, yeah, having a home or not having a home isn't going to make a difference there. If you're looking for a $5 million SBA loan and there's absolutely no collateral, the chances of that loan getting approved, again, depending on the situation, may be less likely. However, I'm not sure that anybody in this room today is probably looking for a $5 million SBA loan. But I'm just trying to make sure you understand that everything is every situation is going to be a little bit different. So yeah, a little bit higher loan definitely, but yes, by and large, you do not have to have a home to get an SBA loan. It's not a requirement, but I can tell you with certainty, if you do own a home and you're getting an SBA loan, I think almost 90 to 95% of the time, if there is equity in that home, the SBA is going to probably make it a requirement that they're going to take a second or some kind of a junior lien to secure themselves in some way.
How do loans work with partnerships?
I mean, really, at the end of the day, it's no different than any other. So when you say partnerships, what you're talking about is the business structure. Businesses can be formed in several different ways. Most small businesses are typically formed under what we call sub-S chapter corporations or sub-S corps. Means that, Doug is a business owner and he's 100% owner of a new business he started, and that's probably done under a sub-S corp. And it's also some of the cases lead to very CPA, very accounting type purposes. For those purposes, it might be better for Doug to form an S corp or a sub S corp, essentially, because he doesn't have to file a separate tax return. He can file it under his personal tax returns, as opposed to a C corp, which is usually a publicly traded company, and those are subject to different accounting rules and situations. A partnership would be things like LLCs or LLPs, things like that. That's just the structure of the organization. The SBA and conventional loans can work with any structure of an organization, whether it's a C corp, S corp, LLC, LLP, or an LLLP, or things like that. There are a bunch of different types of organizations, of corporations. Loans can even be done to trusts. There are situations to where a bank can conventionally and also SBA lend to a trust.
So can a bulk loan for any of these loans be used by not-for-profit or startups?
Not for profit, no. No, SBA does not lend. So SBA in general does not lend to not for profit. So there's really only a couple things that SBA does not lend to. Not for profits is one of them. Just overall, that those have to be conventional, traditional banks, and a conventional loan. Traditional conventional loan would have to handle a not for profit, and investment properties. Those are the two things that SBA does not lend to, are not for profits and investment properties that the primary purpose and repayment structure, primary cash flow and repayment structure of that loan is from the rental of that property. The only somewhat caveat to that is the SBA can finance a property that does have tenants in it, but the operating entity has to have 51% occupancy of that property for the SBA to finance it. So you might be buying a property that has 5,000 square feet, and as long as your business, your operating company is occupying just over 2,500 square feet, if that's to say 2,600 square feet, and the rest of the square footage is leased, the SBA could finance that. But if 100% or point is if 51% or more of that property is tenant occupied, then the SBA will not finance it. But just as a general rule, the SBA does not finance not-for-profit companies.
Do banks look at the type of business for risk assessment on small capital?
Yes, so the SBA particularly, in general, banks do this, but the SBA definitely does this, but I'll talk in general first. In general, a bank looks at the type of industry, and there are a lot of different factors that go into that. Barrier to entry is a big one. So if there's a lot of regulation and there's certifications and licensures and stuff like that, that's a more highly specialized industry. And that actually is a better risk for banks, because they know that if you're, as a business owner, willing to take those steps to get to that point. So like an attorney, there's degrees and specializations and certifications, as opposed to I'm just going to make one up, starting up like some kind of an eBay business where you're selling something online. That's a very low barrier to entry. There's very little you have to do that. Start up a website. In most cases, those things are provided to you. That's a low barrier. There's a higher risk sometimes in those, because those businesses can come and go. Whereas an attorney or a CPA or a construction company, those have to have specializations and certifications and degrees and things like that. It takes more to get there. The risk in those can be lower by and large, as opposed to a startup company that has a very low barrier entry. Other things that are taken into effect, especially the SBA does this, they look at what's called default rates. SBA loans in particular, in fact, even other loans for that matter, banks have access to what's called a default rate list. And what that shows is how risky certain businesses are. So for example, during the pandemic and even somewhat post-pandemic, restaurant industries are riskier. And a lot of banks don't finance as many restaurants right now, because those types of businesses are looked at as riskier, because the national default rate of those type of businesses is higher than, say, a attorney practice or a retail operation, selling some kind of a whatever they're selling. Those are looked at in different ways. So yeah, the risk rating is also determined by things like default rates.
Great answer, Frank. We have time for more questions. Just up the slide here. Just want to remind you to visit score.org/Minnesota. Again, you can see the future calendar for our webinars and workshops. Also request a mentor, and you will be receiving a survey. I think Frank did a great job. I would give him a 10, but we want you to please fill the survey out and also let us know other topics that may be of interest to you. But we still have time. So any other questions you want to type into Q&A or chat, we've got time for those. Please do so. Got one.
I did want to mention something real quick too before everybody. Oh, so real quick, does SCORE do mentor? Does SCORE? I believe you guys mentor nonprofits, correct?
Yes, we do. We work with nonprofits all the time.
And somebody asked about
there's a question. Good. Yes, we
somebody asked about the PowerPoint, and I know you're gonna so you already mentioned it once, but yeah, this entire PowerPoint is going to be provided after the fact. How is your credit considered in a loan? So I can tell you that by and large, credit score and the credit, more important, consumer loans, the credit score is more important, but so is the history by and large. Because typically things like, getting a car loan and things like your credit score drives more of that. You'll find that most often on the conventional or the SBA commercial side business loans, the score doesn't mean as much as the history. The score still needs to be good, meaning it needs to be, say, 620 or 640, somewhere in that range, kind of mid 600s and above. But it's the history that's really what's more important, typically on business credit. So when the risk is being assessed by the SBA or by the conventional loan side, that score doesn't mean as much as that history typically does. I did want to bring up something that I meant to mention earlier, and I hate saying this towards the very tail end, but I brought up home equity loans earlier, and I wanted to touch a little bit more on that because you're going to find, and I found talking with customers, I'm going to pick on Doug again. Let's say Doug is starting a business, or he's already started a business and he's used some of his own cash, but he does need some additional assistance, whatever the situation is, but it's small business. And I can tell you real live example. I've had conversations like this, even as recent as a week ago, or even this week. Customer has a need, they want to inject capital into business, maybe an SBA, and then particularly because it's a startup business, that's more of an SBA loan. But there is a creative way that a bank can look at helping finance that customer, and the path of that might be a home equity loan. And the reason why I say this is because that if Doug, for example, is the business owner, he's 100% business owner, and that way it's nobody else, there's no other partners, it's just Doug, and Doug might have equity in his home. And Doug might say, well, I only need $50,000 or maybe $100,000. And if Doug has a couple $100,000 or $100,000 and he only needs 50 of it, a home equity loan is a good option and an alternative to, say, an SBA loan, particularly because the size is smaller. He has the equity in his home. The SBA anyway is going to secure themselves probably with the equity in his home anyway, but the interest rate on that home equity loan is going to be lower than the SBA loan. SBA is typically going to be like prime plus 2 or 3. Home equity loans typically are just prime. So there's a difference in the interest rate. The SBA loan is going to be principal and interest payments. If prime changes, the interest rate can change all that. Prime is also going to change. It can change the amount on the home equity loan, but it's only going to require interest only payments. So for like a startup business, that can be very helpful because then the business doesn't have to pay all that money back right away. Also, for accounting purposes, your CPA, because Doug is 100% owner, CPA can more than likely write off that interest because that business owner, Doug in this case, is actually utilizing the equity in his home. The CPA might just say, well, Doug, we're gonna officially do like a note payable from you to the business. That way the business shows some debt that it needs to pay back to you, but they can write off that interest. So that interest that you're charging through that home equity loan can also be written off through your business. So if your business does operate at a net profit, some of that can be lowered because ultimately Doug in an S Corp situation is going to have to pay that tax anyway because he's the S Corp owner. But in some cases, that home equity loan might be a decent option. It takes longer to get an SBA loan. Usually, by and large, it might take about 30, 45 days or so to get an SBA loan. Home equity loans through most banks, you can sometimes get them within a day or two and even close them within a couple of days after that. So that from the expediency, you can get access to some of that cash a lot quicker. But that's the caveat there is that you have to have equity in your home for that situation. But I've actually help some customers because they might come to me and say, I'm only looking for $50,000. And I might just simply ask them, do you have equity in your home? And if the answer is yes, I typically might advise them to go the home equity route just because it's a little quicker and easier access to cash.
And we do the same.
Yeah.
Well, I want to thank everyone for joining. Frank, great job presenting. I don't know if
Thank
there's
you.
any last questions anyone has. Frank, will your contact information be on the slide somewhere?
They were on my slides, I believe.
Okay. Your
Hold on.
slides are going to be the ones presented or get sent. So you'll get a copy of Frank's slides and the recorded webinar. Let's see, one more question. My qualified opportunity zone business is a rental property business. I have to improve the building by 100% of the purchase cost. So how can I get a loan to build a brand new rental home after demolishing an existing unattainable or uninhabitable home?
Right, so that's a construction loan. Certainly, there can be options. So SBA will not be able to do that because SBA does not do investment. That would be a traditional conventional loan. So you would talk to a banker like myself. There's a little more to go into that type of a loan because you've got construction. So we have to start. Sorry, I'm going to sneeze. You've got to lay out construction costs, the permitting, all that. You have to have a contractor. You have to really have contact with the contractor and actually probably at least have to the point to where you've got a construction contract ready to go, like almost signature ready. Permitting and stuff has to be kind of ready to go. In most cases, most banks won't finance until you've got that permitting already lined up and either already drawn or already in place. Things like that. But with those types of loans also, that's where conventional loans do get a little bit into what an SBA does with projections, because obviously if you're building something and it's for investment purpose, meaning you're going to be rental of that property, you don't have anybody in that property right now. So yes, in those cases, that's where conventional does get kind of into like an SBA function where it looks at projections. So like I financed single family homes that are built for things like Section 8 housing here in Sarasota. Obviously that home doesn't exist. But that obviously is a little bit less risk because there's a high demand for that type of housing. So, but we're also using projections because that business owner, that borrower has to provide me with information to show what could this property operate and what could it generate in cash flow, not just the rents, but you also have to account for real estate taxes, insurance, other things that have to be paid out. So whatever that net operating income is, that ultimately is what's going to repay the loan. And that's a projection basis because it's not historical. If it's an existing rental property, you can just look at what the existing rentals are at. But in that situation, yeah, it would be financing. It would be through construction. And I think part of that asked, was it 100%? Did it ask, or was it
Yes,
100%,
100%.
100% cost or 100%? Sorry, the question went away, so I didn't see the
Oh, it was,
question exactly. Did it say 100% of cost, or did it say 100% of the property needed to be renovated? Because the reason
it's
why I'm asking that
100% of the property need to be renovated.
Oh, okay, okay. Because if it was 100% of cost, I would say that by and large, you have to put some equity in. Most cases, the land equity becomes the equity in the project. But in some cases, yeah, the land might not be worth enough depending on what the overall construction amount is. So you might still have to put some equity in a project like that. But by and large, usually the land value, the cost of that land or the value of that land is usually what equates to the equity in the project for the loan.
Well, thanks everyone for joining. That's going to conclude the webinar, and you will get the information shortly afterward. Thanks,
Great.
everybody. Thanks, Frank. Appreciate it.
Thanks again, Doug. I appreciate the time.